Your money might be taking longer to show up in your bank account.
The biggest banks in the United States are reporting widespread bank outages for a sixth consecutive day. At the same time, another bank just collapsed, marking the fifth bank failure of 2023. Since last Friday, system-wide processing errors have been leaving millions of customers without access to their money. And while companies insist this is just a temporary glitch, Bloomberg reports that several institutions are still under threat, and experts say more failures would be unsurprising at this point. Americans are outraged with the situation. The outages are keeping many people from paying their bills on time, making them accrue interest debt while they wait for their deposits. On Monday, the Federal Reserve released an alert about the problem, which confirmed that a national processor of transactions is having difficulty in accessing customers' data to complete the transactions. The statement raised suspicion that the disruption was caused by a cyber attack, but up until this point, there is no official explanation about the root cause of the issue. In the past few days, several major U.S. banks released statements on the matter. On Friday, Bank of America, U.S. Bank, and Chase Bank warned clients that the deposit delays would last for just a couple of hours. Your accounts remain secure, and your balance will be updated as soon as the deposit is received, Bank of America wrote on its online platform. You do not need to take any action. Truist also made a similar statement to its customers. Some deposits and payments may be delayed due to a processing issue. This affects Truist and other banks. We're working on this, and we will refund any resulting fees. After realizing that the delays were extending for much longer, angry customers vented on social media platforms about the bank outages. These problems are becoming more frequent. TikTok, hate to say, but the system is cracking, one person wrote on X, formerly Twitter. Another person wrote, "This is beyond frustrating. It causes renters to have late fees. Why is it happening?" Responding to a customer who said, "Wells Fargo direct deposit is officially a day late, and customer service has no time frame when the money will come." A Wells Fargo employee has said, "I noticed your tweet. We are aware of the issue, and we're working on a resolution. We apologize for the inconvenience. At this time, there's no need to file a claim." On Tuesday, X account Finance a Lot noted that the bank issues were a technical glitch with the Federal Reserve System, and that it will take time to work through the backlog. At least that's the story right now, it stressed. Another X user wrote to ask Wells Fargo, "Woke up to my staff about to jump me cause direct deposits broke on payday and winter bonus day. Thanks Wells Fargo and Chase." Now, 6 days after the system-wide disruptions began, clients have been reporting not only deposit delays, but other distressing issues with transfers, duplicated withdrawals, and more. Some say that they haven't been able to log into their online accounts for days. Wells Fargo and Bank of America started directing customer complaints to the Clearinghouse, the payments company that operates the only private sector automated clearinghouse system in the U.S. Clearinghouse is a banking association and payments company owned by the largest commercial banks in the United States. The Automated Clearinghouse, or ACH, is the backbone of the electronic funds transfer system that U.S. banks and other institutions rely on to process online payments. The Federal Reserve revealed on its website that the processing issue at the Clearinghouse had resulted in a number of ACH entries having certain data elements obscured. As a result, those items were not able to be processed by receiving depository financial institutions. In an email to CBS, the operator explained that ACH payment instructions were sent to banks on November the 2nd with masked customer names and account numbers due to a flaw in the system. Because the banks need that data to process incoming payments and to post the money to customer accounts, those payments were delayed, it added. Meanwhile, the Consumer Financial Protection Bureau said it is closely monitoring how institutions are responding to the problem. This disruption underscores the importance of the nation's payments infrastructure. Consumers affected by this processing error should not be penalized, whether by overdraft fees, late fees, or any other penalties. Affected consumers can submit a complaint by visiting consumerfinance.gov/complaint, the agency added. It seems that Bank of America and Wells Fargo clients are being particularly hard hit by the outages. Down Detector reported that the bank's customers were still experiencing issues with funds transfers, online banking, and retrieving account balances today. At Bank of America, day 4, and still no direct deposit, no update on potential resolution, or at the very least, what's being done to resolve the issue. No transparency, no assistance, no communication from you at all. Nothing. Wow, this is so bizarre, one person wrote on X on Monday morning. At Bank of America, where is my money? And will you be covering my bills that are due today? Another person wrote. A frustrated Wells Fargo customer said, Wells Fargo did not post direct deposits into accounts. Paychecks missing and no answers. This is theft. At Ruben Gallego, what government agency can we contact for assistance? Though the situation has gotten some media attention, the truth is that since mid-October, financial institutions have been silently facing operational issues. On October the 20th, international bank Barclays reported an outage that hit more than 2.5 million people globally. The institution's online banking platform locked customers out of their accounts, and given that the bank only offers online services in many countries, clients pointed out that in-branch banking was not an option, highlighting the importance of having cash holdings on hand. Since 2015, nearly 6,000 Barclays branches have been closed. The same has happened to Wells Fargo, Citibank, Chase, and U.S. Bank in the past few years. These institutions also announced thousands of closings last month. Experts say that the payment processing outages reveal that tech integration remains an issue in the industry, and the consequences of compliance failure continues to be severe. Instability continues to grow in the U.S. banking sector, and multiple vulnerabilities are leaving hundreds of institutions under a near-term threat of funding pressure and capital shortfalls, according to a new Bloomberg report citing data provided by Federal Reserve Bank of New York staff. The risks to the system are rising, they said. While some large institutions are less exposed to capital shortfalls, an analysis of models through the second quarter of 2023 showed that hundreds of regional banks are in danger of running out of funds. The March 2023 banking crisis highlighted the vulnerability of the banking sector to a sudden rise in interest rates, the analysts noted. Specifically, banks' ability to limit the pass-through of rate hiking cycles into deposit rates allows them to benefit from higher rates, but only gradually. For smaller banks, rising interest rates have only aggravated their woes. That's the case with Iowa-based Citizens Bank, the fifth financial institution that collapsed this year. In a news release, regulators with the Iowa Division of Banking said Citizens Bank was declared insolvent earlier this week when bank examiners identified significant loan losses that had not previously been identified by the bank. They said that the bank had made a concentration of loans to a single industry, which the company's CEO acknowledged was trucking, outside its Sac City territory and outside Iowa, and incurred heavy losses on some of those loans. The failure was triggered by bankruptcies in the trucking sector amid a nationwide freight recession. Kurt Hoff, a longtime banker in Iowa, who's now a professor of practice in finance at Iowa State University, noted that the last available report on Citizens Bank, dated September 30, showed it had charged off nearly $4 million in loans while earning just $400,000 to $500,000 in income over the past fiscal year. They didn't have enough capital to cover the losses, he said. High interest rates are also endangering banks that have higher exposure to consumer debt, mortgage, and commercial real estate loans. The latest quarterly report on household debt and credit by the Federal Reserve of New York showed that total household debt increased by a whopping $228 billion in the third quarter of 2023 to $17.29 trillion. Meanwhile, mortgage balances rose by $126 billion from the previous quarter and stood at $12.14 trillion at the end of September. Credit card balances also increased by $48 billion to $1.08 trillion in quarter three, representing a 4.7% quarterly increase. Moreover, auto loan and student loan balances went up by $13 billion and $30 billion respectively. Other expenses, which include retail cards and other consumer loans, increased by $2 billion. On the other hand, the rate of loan delinquencies and defaults is rising at the fastest pace since 2008. Many banks are already facing steep losses as loans go bad. The biggest pressure point in the system right now is commercial real estate. The nation's commercial property market collapse is putting the entire financial system at risk. At the moment, thousands of office blocks purchased with debt remain half empty as remote work becomes more popular. These buildings will have to be torn down. In other words, their value is about to sharply drop, leaving hundreds of regional banks sitting on crippling losses. It's a train wreck in slow motion, said Professor Stijn van Nieuwenburg, a property and finance expert at Columbia University. The return to the office is not happening. Data from turnstile swipes shows that occupancy levels are still just 49% of where they used to be, he said. Sensors tracking physical presence in offices tell the same story. Hybrid work is here to stay. Now, lenders are still hoping that office rents will recover and that struggling borrowers will be able to service their debts again. However, according to Professor van Nieuwenburg, banks would do better to bite the bullet now because losses are going to be much worse in 2024 and beyond. His team estimated that America's office stock has lost 40 to 45% of its pre-pandemic level, or will have once the commercial real estate crisis exposes the damage already in the pipeline from two simultaneous shocks: shrinking rents and the most aggressive monetary tightening of modern times. We are starting to see distressed sales every day. Offices are selling for 50%, 60%, or 70% discounts. At these values, the equity holders are wiped out, and lenders take a 30% loss, he explained. The expert added that vulnerable banks are being squeezed from all sides. They're having to raise interest rates drastically to stop deposit flight to money market funds or treasury notes. Their bond portfolios are trading at a large paper loss, which become real losses if they're forced to crystallize them, he emphasized, noting that was the fate that ultimately broke down Silicon Valley Bank. On top of that, revenues are flat on good real estate loans, and developers are throwing in the keys on bad loans. There are a lot of skeletons in the closet, and I wouldn't be surprised if another 200 small banks topple over. In fact, I fully expect another bank to fail at any time, said Professor van Nieuwenburg. Interest rates are even higher now than they were in March. The mark-to-market losses on securities are even worse, he stressed. As of November the 1st, U.S. banks hold $2.7 trillion of commercial real estate debt. Two-thirds is concentrated among the small and mid-sized regional banks. Exposure among local lenders with assets below $10 billion is 280% of their capital. It is 180% for sub-tier banks with up to $250 billion in assets. It doesn't take a big loss to wipe out equity. Fed officials are very worried about this, and they're sending in supervisory teams to look at small banks, he added. This shock is not happening in isolation. All sorts of corporate loans are going to have difficulty refinancing. Credit standards today are about the same as they were at the height of the global financial crisis, the expert continued. If a couple of hundred banks get into trouble at the same time, and there is another run on deposits, this could turn into a systemic crisis. There are some parallels with 2008, he warned. With businesses facing tighter credit conditions, it's only a matter of time before mass bankruptcies start to occur. That will create a self-fulfilling prophecy as borrowers default on their loans, causing struggling banks to take on huge losses and also go under. We're definitely in the middle of a banking crisis that will be unlike anything we have ever seen before, and we should strategize now because things are starting to look very ugly. Thank you for watching.